Multifamily Mindset
Podcast. Think bigger.
Hey everyone, welcome back to this episode of the Multifamily Mindset Podcast. Today we're going to be diving into one of the most important decisions that you guys will make as multifamily investors, and that's going to be choosing the right investment strategy, because not all deals are going to be created equal, and understanding where you guys fit in the mix of core plus, value add, opportunistic can make all the difference. And some of you guys already heard that and was like, what is he talking about? So in order to help convey what I'm explaining is none other than the guest, Zach Rucker. Glad to have you on here with me. He's the pro at all this. He'll definitely be able to help us, break that down in bits and pieces all together. So what's up, Zach?
Hey, Kyle. I'm excited. I love these episodes where we get to jump in and just have a good conversation about different topics, and hopefully you listeners will take something away. And please let us know, give us feedback if there's topics you guys want to learn more about that Kyle and I can deep dive into. Let us know, and we'll chat away all day. So excited to be on here with you, Kyle.
Yeah, glad to have you. So honestly, let's just jump into it, right? I kind of explained just the 4 different deal profiles, right? The 4 investment strategies that we have in multifamily. So we'll kind of cover how they differ and then what kind of investors they're best suited for. Maybe some ranges of returns, you think, right? We can kind of get into that a little bit.
Mm-hmm. Yeah. Well, yeah, we can jump into it. Those that have been listening, that we focus and talk a lot about value add strategy. So we'll dive into that a little bit, but beyond that, there's other investments. And the fun thing about real estate investing is there's no one right way to do it. And there's so many, which is also very frustrating for a lot of people, is that any deal could be a good deal, but bringing that back to the purpose of kind of diving into these different strategies for you listeners is identify what fits in line with what you're looking to accomplish. What are your goals? And then what are also maybe your investors' goals and what are they looking to achieve? And then align that with the strategy going forward. And that's going to help you dial in into the types of properties you're looking for, dialing in your criteria that I know Kyle and I stress a lot about on these episodes and with students that we're working with, is to be efficient and to actually be successful in closing deals. You got to know what you're going after. You can't just go after any deal that comes across your desk. You need to be able to dial that into specifically your strategy and in your market that you're looking into. So with that being said, yeah, you mentioned them, Kyle. There's the core plus. The core. First is the core one. And let me explain. The core is your A+ A-class assets. They're stabilized for the most part. They're consistent cash flow and comparable to bonds is how you can kind of compare those core investments. There's not any really variability to the returns. It's pretty just it just gets managed and is held. So there's A+ A-class assets. There's not any additional CapEx budget that's being poured into these deals. It's more just sitting on it, and you're getting about 7 to 10% annualized returns on those types of deals. But again, it's comparable to bonds. So again, not a lot of variability, and some investors, they need that, and they're fine with that. They don't need the big increase because there's other pieces too that can happen to those core ones, like tax benefits, right?
Yep, exactly. So, I love what you said about some investors needing that. Now, when you say some investors, the first thing that I think about are the institutional investors.
Yep.
Right. Deep pockets, big money, lots of these larger, investment groups that are coming in to try and absorb some of these A-class properties, right? Because, correct me if I'm wrong, but we're going to look at these and we're going to see probably some, lower cap rates. Lower cap rates because you're expecting a lower risk on these properties, just in stable markets, a stable area, part of those 2022, 2023 built properties, right, that just came online that we're looking at. Is that right?
Yeah. No, yeah, exactly. You're looking at new developments that have just been stabilized, leased up. They're running smoothly. You're not going to go in and do any renovations to it. It's just going to, it's already sitting there looking pretty, and you're just investing into that because it's still real estate, and there's some benefits to that, right? but you're not looking for these major returns to necessarily. And this is the piece, right? You said institutional. What's institutional looking to do? Are they looking to get huge gains on investments and really like grow things, or are they looking to keep their money? Right? They're mainly looking to keep their money and not so much take the risks of trying to get these big gains or also potential big losses. That they just want to keep their money. So they're looking for real estate still for that benefit of keeping their money and letting it grow slowly. But going sort of back around, it's the benefits that they get from taxes and reducing their tax liability. That's helping them keep their money instead of focus too much on growing the money. And so the other strategies, as we go further along down in these strategies, we'll see the different type of investor demographic that goes after those.
Yeah. This is definitely that wealth preservation, right?
Mm-hmm.
So for the big funds, those, I guess REITs would kind of be in it a little bit too, right? Not necessarily for some of those individual investors out there who are just looking for those high cash flowing deals and looking to really build that equity into the property. So just keep that in mind. If you do see a deal advertised as a core deal, if you're just getting started out in syndication, it probably isn't something that you might be jumping into immediately.
Mm-hmm. Yep, exactly. And then the next one is the core plus investments. And so these ones can still be A class properties. They're A and B assets that may need some minor improvements. So a little bit of some capital needs, but really not a lot. And these returns will be between like that 9 to 13% annualized return. So there's some variability there. So a little bit more than that core investments. So it could be an A class property that you're like, okay, the developer developed it really well, but they're missing some amenities that tenants, would like. And so I'm going to go in and still add in some new amenities, increase the potential of the property or the revenue. Some missed out things that the developer maybe didn't take care of, nor did they really need you to hit their numbers. And so there's some opportunity you can capitalize on. Those can be, again, decent properties. I actually went toured a couple core plus investments because I wanted to get a little bit more insight to see one, how they're being built, what tenants are looking for right now in this market. So I'm in Utah, so I was looking at some new developments in Salt Lake City and a little bit north, closer to Ogden, that are really high growth markets right now. Like there's a lot, they're awesome markets, very strong, a lot of development, a lot of new supply came online in the past year and a half, past 18 months. There's been a lot of supply in the market, and so I took the chance to go look at some of these newer properties. Now they were stable. They have been leased up, but we were able to see in some of the units, and they're actually micro units. And so the units were like 200 square feet, 300. Wow. The max was a maybe 500 square foot unit, but they only had a couple of those out of both of these buildings I went and looked at. So like an interesting demographic with these new developments, especially in cities, going more of the micro, and the rents were just ridiculous on how expensive they were. But playing the numbers out, like that's where I'm sitting at, is those 9 to 13% annualized returns. Like I can't push that up more unless I'm dropping the price to hit the returns that I'm looking for, which is more than a value add.
Tammy Lizer here. When a tenant steps on your property, their experience starts with your signage. At Signs First, we help multifamily communities stand out with smart, strategic wayfinding. Installed fast with our one-and-done guarantee, we've done over 50,000 doors and we're just getting started. Visit signsfirst1.com/multi-family or call 615-297-5681. Let's transform your property together.
Side of things and what my investors are looking for. But these could be good opportunities for investors that are still like that institutional size, but they're looking for a little bit more in the returns. I think one of them was in an opportunity zone too, which that's another tax benefit, right?
Yeah. Yeah. I mean, I think it's kind of like the value add play, I feel like, for the institutional investors, right?
Yeah.
Because realistically, like the properties I used to manage, I was a part of two different sales of properties, right? Partly in a whole portfolio. And that's usually where you'll find them encompassed in portfolio purchases because they have the money, like part of a $1.8 billion acquisition, right?
Oh, wow. Okay.
That's That's a little bit deeper than I expect. Now, the property I was at, it was a Core Plus, right? Now, obviously, we don't advertise it as a Core Plus just on like a property management level, but like there's still little bits of value to unlock, right? So we were slightly under market rent. Like we're not trying to be the top dogs in the market still, right? We know our place. We're not those newly developed, that fully leased up properties, right? We could do minor, upgrades here and there. When I say minor, I'm talking about we're introducing better washer and dryers to the units. The units haven't been updated in about like 10 years or so. So you can still do those upgrades, but it's crazy to say 10 years ago being 2015, right?
Wow. Yeah.
But if they weren't upgraded for 10 years, are they really outdated? Not necessarily, right? They still have, good, laminate countertops or laminate flooring or something that still holds up pretty well. But just increasing those slight things such as better washer and dryer just to, make them larger. Maybe just doing some renovations like paint or sanding down flooring in the building, just things like that. It does come at a little bit more of a cost, but that's how they increase their rents just little by little, maybe 30, $40 here and there. But that also helps with still some of those like longer term holds. But again, you're looking at that like 7 to 13% in returns or things like that, but deeper pockets for sure.
Yeah, exactly. And that's actually the washer and dryer piece that they actually started doing that one of the properties, and they're all like studios for the most part. And so there's like a corner in the main room of the studio that they decided to add a little closet so they could put a washer and dryer in there. And it was funky because the wall for the closets didn't go all the way up to the ceiling because previously they had a vent. When they first built it, they had a vent up high, and so they couldn't build it all the way up. And so there's a little like loft space to like throw side. So it just looks weird. It looks funky. But they're doing that for this piece. So like, okay, let's add a little bit more value and let's see if we can get a little bit more revenue. Here's our value add play within this core plus investment to get a little bit more, even though they already have like on-site laundry on the building, and they're decent. It's a decent laundry room with machines, but that little bit of push it of, okay, I'm already charging an arm and a leg, but I'm gonna, give you a washer and dryer and charge you some more for that in your little studio, 200 square foot apartment.
Shoot, sidebar. It reminds me of, I don't know if you've seen some of these mall conversions that are happening now, to where they're using like the old storefronts that are vacated spaces within a mall, like the upstairs area in some malls, and then turning those into smaller units. And I've seen those like 200, 300 max square feet. And it's like small, flat, like, microwaves or things like that on like a flat surface, just as their kitchen. And it's extremely tiny, but they are charging an arm and a leg out there. But compared to what some apartments are in those areas, it's reasonable, right? But it's funny you say. I saw that the other day and I was just so surprised.
Yeah, it's crazy. It's crazy what people would pay for a little studio. But I mean, I can imagine like the turnover cost too, because you're not gonna have people there too long. But when you're in the city, you want to live close to work and not have to travel, and that's the other piece too. With like this was downtown, and there was like 20 parking spaces for a building of over 100 tenants or 100 rooms. And so like you don't have much parking options, so you better not have a car if you're going to move there and live there. You better not have one because you're not getting a spot. Just interesting pieces there. So that's core plus, right? Okay, next one. This is the one that we focus the most on: value add investments. This is our B and C. This is the bread and butter of getting good returns, fighting off some risk. So B and C class assets, they need improvements, right? They're run down. There's some high upside potential, but again, we need a lot of capital to infuse into those deals, 10, 20K plus a unit, sometimes more. And these are the returns we're getting: 13 to 15, ideally up to that 18 to 20%. I'd say 13 to 15 on the IRR side, 18 to 20 on the ARR side. The analyzed returns is what we're targeting for these value add investments. You want to dive into that?
Yeah. So, and these value add investments, again, this is, as Zach said, the bread and butter. This is exactly what we're looking for, because we're focused on now not only getting some more cash flow from the property, but we're looking at how much equity we can build into it, because part of where we're getting a lot of our money, I don't think people talk about enough, is going to be the equity at the end of the sale. So if you're looking at a property and you really cannot figure out how you can add in more value on it, look, it might not be a value add property, but for these properties, we're talking about these 1980s and 90s built properties, sometimes 70s, where maybe the kitchens are outdated or you have old amenities, rents are below market rent. I like to use my, threshold for that below 20% market rent. That gives me an idea as to like, hey, there's a reason they're not charging market rent, right? It's probably a value add property to where I have to inject some sort of like capital into the property in order to get it up to speed so it's rentable again, right? And I know, it's going to be teetering on a pretty fine line of, hey, is the occupancy levels pretty good? Or are we getting towards that level to where it might be what we'll talk about a little bit later, more of that opportunistic type of thing, right?
Mm-hmm.
So just be prepared. These are ones that I don't want to go in there and tear down the entire unit, right? I don't want to tear down walls and try to restructure the entire thing. No, I'm saying, hey, maybe at most I'll look to rip up the floorboards and put in new flooring, right? And then we'll change cabinetry, give them some new appliances. Ideally, if I could, we'd go in there, paint the buildings and not have to do anything, right? But then that's
lipstick on the pig. That's lipstick on the pig, Kyle.
Yeah, exactly. Right. But if there are improvements that we need to see, at the end of the day, these are people's lives that we're trying to improve by improving their homes. So It's very important to take your time with this and like actually see, hey, where can we really utilize this capital that we're bringing into the property to really revitalize it, give the residents a better space to live. And also at the end of the day, yes, it will put more money in our pockets, but not necessarily just from, market rent increases, but from how much value we're adding in on property.
Yeah. And I think a big piece to kind of even go back towards like the core and core plus investments. You mentioned like we're really looking for that equity, but it's not, are we riding the market wave of appreciation like in home sales, and you buy a house and it's going to appreciate and we're going to make money off of it. Excuse me. We're going to force that appreciation. So what does forcing that appreciation mean? It's increasing the bottom line, the NOI, the income. It's a business that we're buying. And so we're going to force appreciation. We're going to improve that business and the income, which is going to give us that equity piece. So we're creating that. We're not letting the market create that. We're creating that in the deals that we're looking at with this value add piece. Whereas, core investments, core plus are really, if you're not doing much, you're just kind of sitting on the property. Your equity is going to be built from just natural appreciation, and then the debt buy down, and gaining equity of that piece. Like that's, a traditional housing, single family home situation market. But with value add, we're forcing that. Right. We're putting that work into it. And within value add too, I think there's a big piece that isn't necessarily highlighted is there's some light value add deals and there's some more heavy value add deals. And so you really have to define even within value add investments, like what level are you willing to take on? Like, right, you mentioned you want to go into a deal and hopefully the unit's already in good condition. You can just throw some paint on the property, make it just feel like a better property to live at, right? And that's very light value add. Rents are below market. You just can go in there and raise rents and manage it well. Or there's the ones where, flooring has to be replaced. The cabinets are kind of falling off and you got to replace cabinets. Like that's going to be the heavier lifts that are going to cost over $20,000 a unit to renovate all that and do the exterior. And that's a lot to do. That's almost on the line of getting towards the opportunistic investments, but it's still not value add. So I think I've seen a lot of deals come across where people are like, oh, this is a great deal. Like it's a C-class deal, but it just needs some love. And I look at it and it's like, yeah, it needs too much love. Too much that it's not going to hit the returns that we need because we're putting too much capital in there. And there's not enough ROI. There's not return on investment for how much capital needs to be done to that. And so we're not willing to take that risk there with some of those value add deals.
Yeah. And I know that's ran into a lot, especially by a lot of students, right? They're going to look at these deals and they're like, man, it just doesn't make sense to renovate all these units. And keep that in mind. Sometimes you don't have to renovate everything, right? Sometimes you can renovate part of the property and you're still going to be able to get the return on investment that you're looking for. But there gets to be a point where you put in too much money on that property to where it's so much to raise. It's going to take a little bit longer for you guys to bring that in. And you're risking a lot more capital at the end of the day too, right? So sometimes you might want to sit back and really see, okay, what's going to be the best business plan here? That's where you kind of really get into the underwriting a little bit more and saying, how am I really custom, building a business plan for this property that works? Ideally, when I look at a property, my buy box kind of defines the basic business plan as to what I'm going for, but I tweak it, on a per property basis. And it helps give me so much clarity because, again, some of those you're going to find as you continue looking at properties like, man, if I have to put in X amount or more on this property, it's not going to be worth it. And then you can start using that to, filter through some of these properties that you're looking at to save yourself a little bit more time. But also, again, take a look at, hey, what if I only do half of the units or 60% of the units, 70% of the units, as opposed to everything, right? I had that conversation with somebody, honestly, just a few months ago, and it brought so much clarity to their underwriting, right? And it's, take your time with it. You don't always have to do everything. It's about, really managing what you can work through, not trying to be the end all be all for it. I know we want to improve their lives, but just take your time.
Yeah, no, exactly. It's that weighing that balance of we want to improve that property because we want to improve the community and we want to improve the tenants that live there. But we also need to hit the returns for our investors. So what is that balance of how much work do we do to get to those returns? And then what you said is on the back end of that, what does it look like for the next buyer? So maybe this deal is more of a heavy and a value add. And so you do some of the work and then you sell it to another value add investor that does some of more work. And then it just keeps going along that path of, value add investors until it's a really good stabilized property. But over time, it's still going to, the cycle of that property because of the age is going to continue to fall in that value add category. So you don't have to go do all the work because at some point it's going to need to be redone to a new level anyways. So it doesn't need to be perfect. It's go and get some work done, improve the community, improve the lives of those tenants that live there or the new tenants that you're going to bring in. But then also make sure you're hitting those returns for your investors. And these types of investors are going to be more your retail investors, your everyday investors, a lot that might not even know they can invest in real estate, but they can. And so we're teaching them that you can invest in real estate. You can own these apartment complexes and you can hit these awesome returns that outside of what the stock market's hitting and what your 401k is getting right now. You can move that money and invest into real estate and get better returns because of just all the benefits of real estate, right? And that's where like a lot of people work within this value add strategy because there is a lot of benefits to it. Yes, there's still risk because of the higher, we have to put in some work. And so some deals can go south. It's not all rainbows and butterflies with any of this. Deals do go south, but that's the important part you mentioned of like really identifying your business plan and how much are you going to actually put into it to make sure it's as safe as an investment, but still growing your wealth in that category.
Yeah. And I do want to add one more thing just on the value add. Just as a reminder, when we're going through that, and I only harp on this so much because that's what we teach, right? And that's what we really have students focus on. But remember, your entire business plan does not happen in year one, in year two. Maybe you might have it go on to year 3, year 4, even year 5, right? You're slowly renovating units. Because remember, the goal is that we're slowly increasing what our NOI is so we can force that appreciation to the property. I see too many times that people get frustrated because the deal doesn't work because they said it's not realistic to increase 100% of rents year 1 or even to year 2. And it's not, right? Imagine if you're living somewhere and all of a sudden like your mortgage or your rent jumped up $250, just for the following year and it's the same stuff around you. No, that's not realistic. Now, if it jumped up, $25 or $50 in 1 year, and then it kept doing that year over year, going on through 5 years, although we're getting to that same end result, right? Now, all you did was take less cash flow, up front, but it doesn't all have to be done at once, right? I don't want to have people get too lost into that. And just remember, like, these plans do happen over the course of 3, 5, 7, 10 years, right? So keep that in mind.
Yeah. That's a whole nother topic we can
Yeah.
discuss on is the operations of running through the business plan and what that looks like. But it does come to the underwriting piece. And you don't realize that until you've actually, taken over a deal and gone through that process of what that looks like working with property management, as leases expire, raising rents, or renovating those units and then increasing rents and making sure you stay in line with the market, but not being too aggressive. Now, all those variables happen, and that experience happens as you actually go through a cycle of a deal. So those that are new to underwriting the deals, sometimes they get stuck in the numbers, like you mentioned. They get stuck in just looking at, well, I need to hit my return. So yes, we're going to raise rents $250 all in year one. And it's like, okay, I get your numbers and what you're trying to achieve, but realistically, we have to spread that out from just being able to operate that efficiently and conservatively to get those numbers. Some people can. I mean, I'll be honest, some people can jump in and raise rents $250 just like that, and they do just fine. But those are the properties that are actually way behind on rent and they have never been adjusted and increased. So sometimes you can get those because those tenants are going to look around and say, well, I can't get anything else better or cheaper in rent. I've been lucky to have this rent for the last 5 years, not move a penny. So you can find those, but don't assume that when you're underwriting. I just take that as a cherry on top when you're operating the deal and you can hit that.
Absolutely.
Yeah. Okay. The last one is the opportunistic investments. So these vary. So these could be like a new development deal. So you're starting from the ground, you're building a new development deal. You don't have any cash flow. You're dealing with all that. There's high upside because when you go to sell that property, you can get a huge equity chunk from that. So the returns can be 20+% annualized. I saw a deal that was like 40% IRR that they were projecting for this like RV park, which was just insane. And that's possible because it's a huge risk you're taking of a new product that you're coming online and doing. The other piece to opportunistics is not just the developments, but it's those D-class properties, those vacant buildings that are like just on the verge of being condemned and they need to be completely turned around. So it's those rough properties that they're in a position to be essentially redeveloped. So you're still kind of in that development space where you got to go in and completely turn the property around by just renovating the heck out of that thing and putting so much capital into it. And again, you're not cash flowing at all. There's no cash flow for operations. You don't have any tenants really in there, or if you do, you're working on kicking them all out because the building needs a lot of work to it. That's a whole nother animal that I know myself. I'm not willing to touch that. The development side, yeah, I would love to get into development side, but those D class properties, like I'm not touching those. I'll let the other experts touch those.
Yeah. I mean, it really is the definition of a high risk, high reward, but like the risk is everything, right? I mean, to touch on the fact that you can talk about distressed properties and new development in the same sentence and it's the same risk, right? It's like, look, you're not getting any cash flow from any of these for probably the first 2-3 years, right? Distressed properties, because you have to spend time like, okay, what's the problem that is distressed, right? What's the reasoning that vacancy is so low? Because there's an aspect of, hey, you could just have a bunch of down units, right? So now I have to go in there and fix all of those down units because whatever fire, flood, or anything like that, right? And then you have to spend even more time after fixing them, leasing those out. And honestly, just as when we look up a property and we type in fire or flood, tenants do that too. Now they know, okay, well, this building was on fire, right? So what's the case? What if it happens again, or it was flooded? What if it happens again, right? What contingency is in place? And they're looking for that too. And there's a risk in that. So definitely keep that in mind because you're not going to have cash flow immediately. It's going to take a couple of years. We're not talking about quarters, talking years here.
Yeah.
And then same thing for just that ground up construction. Like, understand when we're talking to investors, I have to go to, one of my buddies and I tell them like, hey, look, this is what the business plan is for the property. And you'd expect to start seeing distributions, third, fourth, maybe the first quarter, second year, something like that, right? Because that's when I anticipate starting to get some distributions back from your investment. But in this case, I'm kind of saying, hey, Zach, can you give me $150,000 and I will hopefully give that back to you in 6 years after we sell the property, right? And you might get distributions in year 4, depending on if our vacancy meets that break even of X percentage, right? Like there's so many different things that goes into it and that you're hoping for. But there's a lot of time that people are putting their money there and they just have to wait. It's a scary thing to me. But again, I don't have as much experience in even looking into those because it's just so much risk.
Yep. No, definitely. And I mean, sometimes those timelines can be shorter, right? They could be 18, 24, 36 months type of timelines as they're in there to quickly flip it if it is a distressed property or development. Like obviously they want to develop it as the quicker the better, because then they know they're not getting cash flow, so they know they're just spending money to operate at the moment. And so obviously the timelines can be compressed there, so you're taking the high risk for a shorter period of time, but yeah, it's still a high risk situation. And you know, to go after those is you got to have a huge experience in the construction space or development space or rehab space. Yeah. Oh, and financing. Yeah. Like you gotta know a lot to be able to go tackle those properties. Whereas like in the value add space, I think it's a little bit easier to understand the process and to be able to go tackle these deals because we can use a lot of resources of property management companies and lending brokers, insurance brokers, even the real estate brokers that we're using to find the deals. Like we can utilize a lot of their expertise to help us put together deals and find the right deals and put all those pieces together to help operate it. But then these other ones are a little bit more nuanced strategies that take a little bit more, or you just need to have different types of resources to tackle those, which, you know, again, people are tackling any of these every day. These strategies are happening every day as it is, and people are making money. It just comes down to what are you comfortable with and what do your investors want to tackle and what seems appealing to you and your strategy. You know, I think at some point for me, you know, and I see myself tackling, you know, multiple of these strategies in the future. Value add is the bread and butter, right? We talked about, but you know, can I get into a development deal in the future? Yeah, I would love to do that. So that opportunistic investment, that would be fun to do. Core plus deal would be nice to have something a little bit on the newer end that we can still add some value to, because I always like that piece. Core investments, I probably won't touch that. That's just not enough return or not enough reward there. But the core plus, between the core plus and opportunistic, like there's rooms to expand in that because they are just essentially arms of value add. It's just different degrees, right? And we gotta pick the risk level that we're willing to take and so forth. So, you know, I think value add is like that, the gateway drug into it, and then you just expand from there.
Yeah. I mean, but to your point, right? You're getting extremely experienced with it, and as you're getting more experienced, you're now starting to think about just those other different deal profiles, right? So, you know, with understanding more financing options and construction and execution of deals in general, right? Like that's how you're getting more comfortable into it. Because if you don't, like, you're just risking more of losing the entire investment. So, if you're just starting out, that value add, I mean, and technically, I guess core plus, right? It can even be something you can look at until you build up some more experience getting into this. So, you know, just going through all those deal profiles, like you'll just spend your time with it. Value add is definitely something that is a little bit more newer investor friendly.
Yep. 100%. Yeah. And then, identify that and then go after it. And we'll be back for more content episodes on just diving into the value add and maybe some of these other strategies and what that really takes. Again, within real estate, there's so many avenues to go down, so many asset classes, not even just multifamily. This applies to other asset classes as well that you're going to be dealing with. This is just the strategy, again, with that we're just focusing on multifamily, but yeah, again, applies to storage units, even mobile home parks. Like you can have a core mobile home park. You probably wouldn't hear that, but you can have a pretty nice new developed mobile home park that's doing pretty well, and then you can have the opportunistic one that you gotta really shape up because it's in rough shape. So that's with any really asset class there, and understanding those. It's just, where's your risk profile? Identify that, and then jump into it.
Yeah, exactly. Well said. Well, I mean, Zach, is there anything else that you think you want to add in on here before we wrap it up?
I can talk all day, so we better hurry and wrap it up.
Okay, that's great. So, I mean, I hope for all of you guys listening, that gives you guys like a really clear idea on these different deal profiles and different strategies that could fit you guys, or what future state of you could look like next, right? So if any of you guys got any value from this, and I'm sure you did, like, just be sure to share this out with potential team members who you think might be looking into some deals that don't really fit in that value add that you're looking at, right? And if you guys want to learn more, like, please feel free to reach out, let us know. We'd love to be able to go even further in depth. You heard us kind of getting off on a little bit of a tangent, and sometimes just not trying to get too much into the details, right? But we appreciate you guys for listening. So until next time, appreciate you just listening on this episode of the Multifamily Mindset Podcast.
We'll see you guys.
See ya.
Multifamily Mindset Podcast. Think bigger.